All right, let's dive right into this explainer. Today, we're unpacking what I call the great financial disconnect. We're going to bridge the massive gap between what the headlines and official statistics are telling us and what you actually feel in your wallet every single day. Here is our roadmap. We'll hit 1, the personal wealth illusion, 2, decoding the stock market, 3, designing systems for success, 4, the hidden economic recession, and finally, 5, the global currency shift. Let's get into it. Starting with section 1, the personal wealth illusion, why $100,000 and millionaire status aren't exactly what they seem. You know those headlines saying the average 45-year-old is practically a millionaire? Yeah, if you felt like you were falling behind, don't worry, you aren't. They're using the average, which gets totally warped by billionaires at the top. The actual median reality, the person dead center in the middle class, is sitting at about $247,200. So it's $250,000, not a million. And honestly, here's the real trap. Most of that $250,000 isn't even cash you can use. For your typical 45-year-old, about 65% of that net worth is literally trapped inside their walls as home equity. It looks fantastic on a spreadsheet, right? But it doesn't help you at the grocery store checkout line. I mean, you can't pay your electric bill with drywall. And speaking of bills, let's talk about that holy grail, the 6-figure salary. Why does making $100,000 feel like you're broke? Well, because today, $100,000 only has the purchasing power of $36,000 back in 1980. Once you factor in today's housing, taxes, and childcare, the 6-figure club didn't just get more crowded, the VIP lounge got way, way smaller. The number that used to mean beach houses is now what people use to barely afford an average home and daycare. Moving on to section 2, decoding the stock market. Let's make sense of all the chaos. Since saving your way to wealth is kind of a mathematical dead end right now, we gotta look at putting money to work. Let's skip the casino mindset and break down the basics of ownership. Owning a stock, you're just buying a tiny growing slice of a real company. Dividends, that's just a nice little thank you check cut straight from their profits. And indexes, like the S&P 500, are basically just a market report card. It tracks a bunch of companies together so you know exactly how the overall economy is doing. Now, markets naturally swing between 2 major moods. You've got the bull market, charging ahead, prices are rising, everyone's super optimistic. And then you've got the bear market, swiping down with falling prices and a whole lot of fear. The trick here, smart investors don't freak out when the bear shows up. They just prepare for both. So how do you actually survive those swings? Enter what we call the lazy genius strategy. First, diversification. You just spread your risk out. Instead of betting your entire life savings on one hot tech company, you use index funds and ETFs to grab tiny pieces of hundreds of companies all at once. Mix in some patience and you completely avoid the emotional roller coaster. Remember, time in the market always beats trying to time the market. Just let the system do the heavy lifting for you. All right, section 3, designing systems for success. Stop owning a job and start owning a business. If you're out there trying to build wealth through small business, listen to this quote. You don't build a business, you build a system, and the system builds the business. This is literally the exact moment you graduate from being an overworked employee in your own shop to an actual business owner. If you can step away and the whole operation grinds to a halt, yeah, that wasn't a business, that was just a really stressful job. Every founder basically wrestles with 3 internal identities. First, the technician. That's the doer, the one baking the cookies or writing the code. Then, the manager, the organizer who makes the schedules and tracks the money. Finally, the entrepreneur, the visionary looking 5 years down the road. If you are stuck only operating as the technician, your business becomes a cage. It's going to collapse the absolute second you stop working. To break free, your business has to evolve. Step 1, you are the business. Step 2 is adolescence. This is where you start delegating, hiring, and writing down exactly how things are done. And step 3 is maturity, where the business actually runs itself. Creating those standard operating procedures pushes you right through these phases until you physically being there is completely optional. And honestly, that is the true definition of financial freedom. Which brings us to section 4, the hidden economic recession, why the data absolutely does not match your reality. Okay, even if you nail your personal wealth and build a great systemized business, the macro economy is shifting right beneath our feet. And this is the big question everyone's asking. If official unemployment is sitting around 4% and GDP is allegedly growing, why does everyone feel like we're just barely holding on? Why is there this massive gap between the headlines and our lived reality? It all starts with how we actually measure things. Take the official unemployment rate. It only counts people who are actively applying for jobs. So think of it like a broken scale. It completely misses the 1.6 million Americans who simply stopped stepping onto the scale and gave up looking for work entirely. By ignoring that massive drop in labor participation, this broken scale artificially lowers the headline number while real people quietly fall out of the economy. And here is the reality on the ground, the hidden recession. To explain a recession simply, it's exactly like a household losing its primary income source. To survive, that family is forced to take on 2 part-time gigs with 0 benefits, and they have to rely heavily on credit cards just to cover the basics, all while pretending everything is totally fine. But here's the kicker. The government counts those 2 part-time gigs as job growth, totally masking the severe drop in actual job quality and security. Because recessions are declared retroactively, often a full year after they actually start, we really have to look at the warning lights flashing on the dashboard right now. We've got 4.4 million Americans working part-time just to survive. Credit card debt just hit a record $1.28 trillion. Savings rates plummeted down to 4.5%, and corporate bankruptcies are the highest they've been in a decade. These warning lights are screaming that the economic pain isn't something coming in the future, it's already here. Finally, Section 5, the global currency shift, the end of exorbitant privilege. Let's zoom all the way out to the macro level to see exactly how these domestic struggles tie directly into the fading power of the US dollar around the world. For decades, the US dollar was the undisputed backbone of global trade. But check out this timeline. The world is quietly waking up and diversifying. In 2000, the dollar was 71% of global reserves. By 2010, down to 66%. Today, it's sitting below 58%. It is a slow leak, but it is a massive one. Being the world's reserve currency gave America what economists call exorbitant privilege, and it rested on 3 main pillars. Intelligence, meaning we could see everyone's trade data, investment, guaranteed demand so we could borrow money super cheaply, and jurisdiction, the power to literally sanction and freeze foreign assets. But when the US weaponized that system in 2022 by freezing foreign sovereign assets, it was a huge wake-up call. It signaled to every other central bank on Earth that they desperately needed a backup plan. And guess what? That backup plan is being built as we speak. The BRICS nations have expanded and now represent half the global population. They're piloting something called the Unit, which is a blockchain settlement tool backed 40% by physical gold, designed to price commodities entirely outside the dollar. And they're using systems like mBridge to settle cross-border trades directly. For the first time since World War II, a coalition of nations is successfully bypassing U.S. correspondent banks entirely. Monopoly power only works when there are no other options. And folks, the options are finally here. Which brings us to our final thought for this explainer. As the US dollar quietly loses its global monopoly, and domestic metrics continue to mask the harsh reality on the ground, what happens to the American economy when the math finally catches up to the official narrative? We've unpacked the gap between your paycheck and your purchasing power, the absolute need to systemize your wealth, and the shifting tectonic plates of global finance. The ultimate question is this: who will be prepared and who's going to be blindsided when this financial disconnect finally snaps? Thanks for tuning in, and keep asking the hard questions.